Huntington Ingalls Industries, Inc. is a quintessential example of how buying a stock at fair value allows you to fully participate in the company. As you can see by looking at the company's earnings per share here, there is some cyclicality, but since 2011, the company has grown at 15.64%. They started paying their first dividend in 2012, and in 2011, you could have bought the stock at an attractive valuation, a PE ratio of under 15, which is the valuation of this orange line. The company grew by 15.64%, and it now has a PE at fair value of about 15. Watch this video to see how the company's performance correlates with its stock price. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, bringing you another series of fairly valued stocks in various sectors. I'm known as Mr. Valuation, and one of the things I want to stress throughout these videos and in this video is I want to keep reminding investors that the key to value investing is that it allows you to fully participate in the performance of the company. If you find a company that you admire, that you think is a good investment, that you would like to own, you want to be a shareholder owner of that business. But the key is you make your money on the buy side. And so you want to be real careful that you're paying a fair value or below. If you overpay for the stock, the company can do great, and you as an investor might not do so well. If you buy the stock at fair value, you can generally participate in the growth of the company. And I'll be illustrating that with the 4 research candidates that I'm offering in today's video. So let's go ahead and get into the video. I've got a portfolio here of 5 industrial stocks that I think you'll find interesting in today's overvalued market. If you look at these companies, the PE ratios are all within that 15 fair value range that I talk about, and their earnings yields are all over 6.5%, which I often talk about. I consider those to be benchmarks because that puts you in a position to participate fully in the company's growth potential. So let's go ahead and look at the companies, and let's start with Deere Company. Now, Deere Company, commonly known as John Deere, is obviously agricultural and farm machinery, tractors and so on. And as such, it's a semi-cyclical company, I like to call it. It does grow. As you can see, the growth rate going back to 2005, and they have an October fiscal year, has averaged just under 12%. And that, warrants a 15 fair value. And you can see how the stock price tends to track that fair value. Now, just up to a year ago, this stock was overvalued. And why did it get overvalued? That's always an important consideration. I believe it got overvalued because we had a really incredible year in 2021. The stock's earnings growth was over 119%, and that was coming off of a down year in earnings, which actually, in the short run hurt the stock price. Remember, in the short run, emotions determine market price. In the long run, earnings determine market price. But everyone got excited about the company with all this growth we had in 2021, and they drove it up to valuations that were significantly above fair value. Now, the stock has since corrected, and it's currently trading at fair value. Now, I'd like to buy this stock a little cheaper, as I always like to talk about. I like to see a margin of safety, but you could invest in Deere Company today with a 1.3% yield at a blended PE ratio of about 15.36. I'd like to buy it around 13 or 14 times earnings. You could have done that, just in July of this year. So, with a little patience, we're facing a lot of uncertainty in the economy. This would be one that you could start building your research on. It's A-rated, has modest debt, under 50% debt, and I think the company is, really well positioned for growth. It's got a good dividend record. Doesn't have a perfect dividend record, but it has a good dividend record. And a good record of dividend growth. So when I'm looking at dividends, as I always like to point out, I like to look at operating cash flow. And here what I'm most concerned about, not so much price, but does the cash flow cover the dividend? And the answer is yes. And the same with free cash flow. I like to look at free cash flow, and Deere Company is generating free cash flow, especially in recent years, that well covers their dividend. So I like the company. From a sales point of view, the company's grown sales at about 7 or 8%, but price to sales is one valuation reference that I think the company's still trading at a rather rich price to sales. So again, this might be one that you'd want to be patient on and, kind of give it a chance to maybe settle into a little bit lower valuation before you start building a position. But this is one of the industrials that was overvalued that's now come into fair value territory. The next one here is Fortune Brands. Fortune Brands has been undervalued for a long time here. Now, this is a very interesting company, in my opinion. Their brands are really, well known. Moen, faucets. They have outdoor brands. They have outdoors and security. They also make cabinets. So you can go into their website and spend a little time looking around at their brands, and you'll see that this is a quality company and very interesting. Now, it's a very consistent above average growther. Notice that the growth rate has been 22.4%, and the PE ratio calculation for fair value is a PE of 22.49. That's using the Peter Lynch P equals growth rate formula that FastGraphs uses for fast-growing companies. Now, going forward, the company is expected to grow about 12%, but then, even then, with a PE ratio of basically 11, a blended PE of 11, I think this one offers you a good margin of safety, a decent dividend yield of 1.65, and some really good growth potential. The future rates of return on this stock, assuming it moves back into what I would call its fair value, which it's traded at most of the time and even above it in years past, would give you an opportunity. Of course, it recently traded pretty close to fair value just in 2020 and 2021. I consider the stock very undervalued and very attractive. Once again, looking at these other metrics real quickly, cash flow is, strongly covering the dividends. Free cash flow strongly covers the dividends. And if I look at, price to sales, the company's trading at a very low price to sales. So this probably is my favorite of the group here that we're looking at. I think it offers the most, investment return. This is a total return conceptual investment here, not necessarily a high income investment, but it does offer a good dividend and a dividend growth. And even at its undervalued level, this stock has still outperformed the S&P 500, a tribute to its massive growth, even though it's so undervalued. You can see also that the dividend has grown at 16.8% compounded, 17.75 on average. So, this is really an interesting opportunity to invest in something that give you outperformance going forward. So I like Fortune Brands quite a bit at these levels. FedEx is another one. FedEx has grown, double-digit earnings growth. You can see how the stock prices track that. It does have some cyclicality here and there. The stock price fell with earnings during COVID. You can see how earnings drive market price. It's currently also undervalued. It offers a 2% dividend yield. Looking at it going forward, it's expected to continue growing about 11.5 to 12%. And remember, these numbers are estimates by analysts. You can also look here at the bottom and see that the analysts have actually been increasing the estimates for the last, 6 months or so. So they're getting more positive, if you will, on FedEx. And as always, you can always check the analyst scorecard and see that they have a pretty good record. Analysts have been able to get it right most of the time, other than COVID really was the big issue in coming out of the Great Recession. They missed some estimates, but otherwise the analysts seem to get this, pretty right. So once again, if I look at operating cash flow, we've got good operating cash flow covering the dividend. I think that's a real key. And the payout ratio of operating cash flow is very low. However, when I look at free cash flow, I get a little different perspective here. The company, was not covering free cash flow in 2017, 18, 19, and 20. They are covering it this year and expect to be covering their dividend in the future. This is a situation where the company kind of went into a transition. You can also see that when you look at the company's adjusted operating earnings, where they had, they lost the Amazon account, or they left the Amazon account actually, but they've now been recovering and they are expected to grow. And of course, stock prices really track the performance of this company beautifully. So I really like FedEx here. I think we do have a nice margin of safety in this stock. I think it's very undervalued relative to its growth and could offer significant rates of return going forward. This is one that I think is worth spending some time learning about if you're interested. Huntington Ingalls is what I featured, and I like this stock here, and I like it for a couple of reasons, for a lot of reasons actually. I'm going to bring in the company's website here just so you get an idea of who this company is and what they are. The company is America's only builder of nuclear-powered aircraft carriers and leading provider of mission-driven defense technologies. It's recognized a 100-year legacy, so the company's 100 years old. And it's one that, again, you can spend some time on the website, but notice how the stock price really clearly tracked the company's operating earnings here. But here's what I want to bring to your attention. If I analyze this stock, they went public in 2011, even though they're a 100-year-old company. And the company could have been bought at we'll call it a 13 PE ratio. The orange line on this graph is a 15.64 PE ratio. It's above 15% growth. So we're using, again, the P equals growth rate formula, and you can see how that really applies to this company. But you have a little bit of overvaluation here, and it ended up basically at fair value with a blended PE ratio of 15.31. So we have 15.6% growth. I would expect then our growth component of total return, capital appreciation, will be slightly above 15.64%. Plus, we get the dividend income, which is depicted by this green line, and you can see that their payout ratio has been steadily increasing over time. So if we look at performance, you can see that this company has generated a 16.51% capital appreciation component in excess of the S&P 500. And then also they've paid dividends greater than the S&P 500 during this time frame. So they've averaged a 17.63% rate of return versus 11.92, with a steadily growing dividend that has really increased dramatically. But again, you've got some anomalous periods. They've been increasing their dividend by, high single digit to, high double digit rates most of the time. Their payout ratio still has room for the company to grow. In 2021, it was 34%. It's anticipated to be about 31% this year. Once again, if I look at this company for the other metrics, they cover their dividends very well with operating cash flow, and they also cover their dividend extremely well with free cash flow. So this is one that I think is also a very attractive company. Price to sales is pretty much in line. I do want to say this about the company. The company is fully viable today with about a 16% growth rate going forward. That would give you a nice double-digit returns. You might want to be able to look for this company at a little bit lower price because, again, valuation is the key and you make your money on the buy side. But it's cheap enough today to go ahead and be looking at this company and considering it, for future investment. So I like it. The next company I'm going to cover here is Pentair. It is the last company I'm going to cover in this video. Now, this is another interesting story, and I'm always looking for my lessons in valuation. Number one is the market value average has been about 18 times earnings. That's the blue line on this graph. So the market is often given this kind of a premium valuation. But again, 15 times earnings, I think, is the true intrinsic value. And you can see if I take that market value PE off, how the company's stock price has really responded to that. You can see when it was overvalued here, which means it was well above the orange line, how the stock price really did nothing for several years here. This is a really beauty of the fast graph tool. I can look, here it was averaging under almost 14% annualized loss each year for about 5 years here coming into the Great Recession. Then the stock got inexpensive, and you can see when it went from being its cheapest to its most expensive, you could have averaged over 35% a year. Valuation matters and matters a lot. But once it peaked in value and it had a little bit of weakness in the company's earnings, the stock price once again reacted and dropped significantly. Last year, 2021, the stock once again got into a real high valuation, and it currently has fallen into fair value territory. Looking at it going forward, it's expected to grow at an average of about 8% over the next couple of years. It does have about a 10% or 9% margin of safety. It would be attractive here with a 1.76% dividend yield, relatively low debt at 27% debt to capital. So, bottom line is I think this is one that you could look at and for the first time in years. Now, the dividend record is a little spotty. You can see that they did cut it because this is a cyclical company. And the reason I like to show companies like this, I do believe one of the keys about investing is that if you're investing in the business, if you're a long-term fundamentally oriented business, it's important that you understand the nature of the beast that you're investing in. And I don't believe any tool does that better than FastGraphs. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. Once again, bringing you some fairly valued research candidates, and this time in the industrial sector. I might want to point out there are plenty of other industrial companies that I'm looking at that are getting close. And I think it's important to recognize that. I'm trying to show you ones that I think you could spend some time researching now and possibly make investment decisions on. but there's no substitute for doing homework. Fast Graphs helps with that tremendously. You can research stocks deeper and faster by using Fast Graph. You can go into their financial statements. You can go into the company's website directly from it. You can go into research services directly from it. But most important of all, you can really assess valuation. Is the stock fairly valued, overvalued, or undervalued? If you like this video, give me a like, ring the bell, subscribe to the YouTube channel. But most importantly, for your long-term wealth and health, take a look at Fast Graphs. At least give it a free trial. It's one of the most powerful investing tools I think you can invest in. I personally wouldn't invest without it. Thanks for watching. Talk to you again real soon.